Hello everyone, just checking if we are live. Please let me know if I am audible and visible. I will wait for another 20 seconds before I get started. Okay, superb. So, hello everyone and welcome back. This is the second session of a 3-session series of ACCA FM revision for March and June 2026 exams. In the yesterday's lecture, we had started with investment appraisal and we had covered 3 chapters of investment appraisals. We had already discussed that the 2 chapters that are of utmost importance, or other 2 sections that are of utmost importance from an exam perspective, are investment appraisals as well as risk management, especially from a section C perspective, which is your comprehensive response, constructed responses, right, which is 20 marker questions in exam. And hence I'm covering these topics first. So today also we'll just be finishing with the remaining chapters of investment appraisal, and then we will be starting with risk management. So without further ado, let's just get started. Chapter 5, my sequence may not exactly match with your sequence, but that's okay. Chapter 5 is asset investment decisions and capital rationing. What do we mean by asset investment decisions? So think of it as if you wanted to buy a car, for example. Now, or let's say you want to drive a car. There are 2 options that you have. One option is, and let's assume you don't have money to buy the car, but you still want to buy the car. You have 2 options. One option is you lease the car, you take the car on rent, okay? And option 2 is you take a loan from the bank and then you buy the car and then eventually you pay the loan, okay? Which of these options will be cheaper to you from a financial perspective? Assume that the quality of the asset is the same, assume everything else is the same. Which of these assets will be cheaper for you? So the first decision is leasing versus buying. Leasing, of course, will be periodic rental payments for the use of the asset, and buying, of course, will mean that you take a loan from the bank and you make an outright purchase. Using that, you own the asset when you buy the asset, of course, but if you have leased the asset, you do not own the asset. So what are the key implications if you go for the leasing option? If you go for the leasing option, you don't own the asset. If you don't own the asset, then what happens is depreciation benefit is not something that you will get. The benefit of depreciation goes to the owner, and the owner, of course, is the lessor and not you. And hence the benefit on the tax relief or the tax allowable depreciation, TAD, is something that goes to the lessor and not the lessee. Good afternoon. So that benefit will not be available to the lessee. But having said that, the lessee will be making rental payments from a time to time basis, and that on that rental payment, the lessee will end up getting the tax benefit. So if you are going for the lease option, you make the payments of lease from time to time, and then you get a benefit of the tax on the lease. If you go for the buy option, what happens? You buy the asset, so there is a cash outflow on day 1, and then every year there is a depreciation. Of course, depreciation we've learned in the previous chapter that it is not a relevant cash flow, but you will get the benefit of the tax relief on such depreciation. And of course, there is no rental repayment. And what happens at the end of the life of the asset? At the end of the life of the asset, in case of lease option, you just return it to the lessor. But in case of the buy option, what you do is you end up selling it for scrap, and hence you will realize the scrap value. So in case of lease, it is purely just lease payments and taxation on lease. In case of the buy option, there is cash outflow on buying, there is annual benefit of depreciation, tax benefit, and then finally at the end of its useful life, you will end up selling the assets. You will realize whatever the scrap value or resale value of the asset that is. Okay, so that is exactly what is mentioned all over here. The one thing that that from an exam perspective is very important, and I would say it is a common mistake as well, is that what happens a lot of times is that in case of the lease option, the lease payments are typically advance in nature. So let's assume for year 1 you will pay the lease on year 0. For year 2 you will pay the lease on year 1. Right, end of year 1, which is beginning of year 2. Year 3 you will make the payment end of year 2, and so on and so forth. So a lot of times the lease payments are advanced by 1 year. So let's say if it is a 5-year lease, your lease payments go from year 0 to year 4. But what we learned in the previous chapter is that the tax payments are generally delayed by 1 year. They are paid by 1 year in arrears, and hence if the question says that they are delayed by 1 year. Now, while the lease for first year was paid in year 0, it belonged to the first year. If it belonged to the first year, right, then you should get the benefit of tax in first year. But the tax of the first year you are paying in the second year. So what happens in such a case is that year 0 you pay lease for year 1, lease for first year, but the tax benefit is something that you will get in year 2. Tax benefit on first year payment, first year lease, which means year 0 to year 4 will be your lease payments, and the tax benefit will run from year 2 to year 6. So this is one case from an exam perspective. Remember that you have to be careful about the time period of lease payment vis-a-vis the tax relief. You should read the question very, very carefully. Number 2, one might ask, okay sir, if I'm going to the bank and if I'm taking a loan and buying the asset, I will have to pay interest, and if I pay interest I will get the tax benefit. But remember, I had told you in the previous chapter that the discounting rate that you take has to be the post-tax discounting rate. So the benefit of the taxation relief on interest is already accounted for when you take the post-interest, or I would say the post-tax discount rate, which is your interest rate that you pay. So you do not have to separately consider, either the interest payments or the tax benefit of the interest payments, because they are already considered in the discount period, which is what is mentioned over here. Now, when you evaluate which option is better between lease and buy, how do you evaluate? Sir, the best way to evaluate is if I am going to earn money, if I am investing in something. Remember, when we were investing and we were to evaluate using NPV, how did we evaluate? We said, what is the project that gives me the highest NPV, the highest earnings? But if it is an expense, I will say, what is the expense that is minimum for me? So if I'm investing in the asset, what is the asset that gives me the minimum expense as in the lowest cost. Lowest cost means least negative NPV. See, in both the cases, your NPV will be negative only because lease is also an expense, a cash outflow, and when you buy the asset, it is also cash outflow. But what you have to choose between the two is which of the two is a lower cost, which of the two has a lower negative NPV. So you have to calculate NPV for each one by one. Towards the end of this chapter, I will run you through a quick example as well. I will show you how it is supposed to be calculated. And then you will compare the two options, and then you will decide which one has a lower NPV, and then you make a recommendation. Do not forget to make that recommendation, because that carries 1 mark. You have to make that recommendation that, let's say if lease is a cheaper option, let's say that the individual should go for, or the company should go for the lease option, because it has the lower negative NPV, which means it has the lower cost. Now, someone might ask, but sir, what happens? I will buy the machinery, right? I will buy the machinery. If I buy the machinery, I will also have some benefit. So, sir, will my NPV not be positive? Of course. But that you will consider separately. The benefit of the machinery is something that you will consider separately. Right now, you are just considering the cost options, whether option A in cost is better or option B is better, whether you should buy the machinery or not, whether you should lease the machinery or not, whether you should have the machinery at the first place or not is a different discussion. That is whether the machinery has a positive NPV or not. But assuming it has a positive NPV, assuming you have decided to buy, or rather you have decided to have the machinery, then how do you have it, whether lease option or buy option is what matters. So you do not consider the inflows over here, you simply consider which of the two options has a lower cost. Okay, which of the two has the least negative NPV. Okay, number 2. Now assume your parents have gotten you a two-wheeler, let's say Activa, right? Now you are in two minds, you are thinking, oh, at what point of time should I sell the Activa and buy a new Activa? Let's assume if you bought the Activa for, let's say, 1 lakh rupees, a two-wheeler for 1 lakh rupees. Let's say if you sell in 4 years, the scrap value in 4 years you will end up getting, or if you resale, I would say resale or scrap value, your resale value will be 50,000. If you sell it in 5 years, your value will be 35,000. If you sell it after 6 years, hypothetically, your value will be only 20,000, or let's say only 15,000. Okay. Now one might say, okay sir, might as well sell it after 4 years. But then if you sell it after 4 years, you'll have to buy a new one after 4 years, correct? In this case, you can postpone buying a new Activa till the end of 6th year. Okay, then what should we do? The other consideration is you have to also pay an annual cost. What is the annual cost? You'll have to pay an annual repairs cost, an annual servicing cost, and as the vehicle keeps getting older and older, the cost of servicing, the cost of repairing keeps increasing. So let's say the annual cost of servicing over here was only 5,000. Over here it became 10,000, and probably I'm using big numbers. Over here it became 8,000. Over here it became 18,000. Now, if you were to evaluate, should I sell the Activa after 4 years and buy a new one, or after 5 years, or after 6 years and buy a new one? When should I replace my Activa? Or in case of a mobile phone also, when should I replace my mobile phone? And in case of a company, when should they replace a machinery and buy a new machinery? Whether in 4 years or in 5 years or 6 years, or as the case may be. How do you do this? Sir, I will simply calculate NPV. But remember, we had discussed that NPV will not consider different time periods. NPV will just give you the absolute amount. Whether you replace for 4 years, 5 years or 6 years, it will not consider the fact that you will have to pay money after 4 years. Okay. So there is two ways. One way is, what I do is I will find the LCM of these 3, 4, 5 and 6, right? And I say, maybe I calculate for I would say whatever 6, 5 or 30 for 30 years. For 30 years I end up calculating, or whatever I end up calculating, where I will say that this is the point in time, or whatever the LCM is, this is the point in time where all of these will have equal time periods, and then I find out the NPV. That is an option, but then that will be a very, very tedious option, so to say. That is a very, very tedious option, so to say. And hence, what is the other option that I have? The other option that I will have is, by the way, the LCM will be 120. You'll have to calculate for 120. But either ways, the point being, the other option you will have is to calculate the EAC, equivalent annual cost. I would say 60 years. You'll have to calculate for 60 years. So 4 years you'll have to consider I will buy 15 times. Then for 5 years you'll have to consider that I will buy and replace for 12 times. For 6 years you'll have to consider I will buy and replace for 10 times. But that will be a very tedious process to solve. So what is the easier way? The easier way is to find out the equivalent annual cost, which means you will find out what is the present value of the cost. Remember, this is an asset decision. Here we are not talking about the incomes, we are only talking about the cost over here. So you'll find the present value of the cost. What is the present value of all the costs that you will incur minus whatever the benefit you will get from the scrap value. That net present value you will calculate for each of these cases, and then you will have to divide it. Divided by what? Divided by the annuity factor. Remember in yesterday's lecture we already saw that the annuity factor, and I can show you the table again very quickly, that there is an annuity factor table. Let's assume your discounting rate is, let's say, 10%, right? So you will look at the annuity table 10% column. You will look at the annuity factors for 4 years, 5 years and 6 years respectively. You will find the present value. And then divide it, and then you end up dividing it respectively. Okay. Yeah. So EAC, which is the equivalent annual cost, is nothing but the present value of costs divided by the annuity factor for the respective lengths. And this equivalent annual cost you have to compare for all three options, 4 years, 5 years and 6 years. And let's assume it is lowest for 5 years. Then your answer is you should replace the asset, you should replace that activa every 5 years. So calculation process is calculate the NPV first, then you divide it using the annuity factor, you find the EAC, and then the lowest EAC is what you will have to, is something that you will have to go ahead with in terms of your recommendation. If you have any queries, please write in the chat box. I have the chat box on my left hand side, and I'm looking it parallelly so that if there are any queries I can quickly answer. Now, what are the assumptions? The assumptions are that the revenues are same across all the three options. Your revenues are the same, the Activa gives you the same mileage, the Activa has the same speed, that the operational efficiency of the machines is the same. It is indifferent between all the three options, 4 years, 5 years and 6 years, or as the case may be. It can be replaced indefinitely. And finally, we are also ignoring any tax and inflation benefits over here. This is a very simple comparison. Okay. Now in examination, instead of a cost, if you are given the benefit, if you are given a set of cash inflows with different lifespans, how do you compare them? What you will do is you will use the same math, you will find the present value divided by the annuity factor. That will give you equivalent annual benefit. This was equivalent annual cost. Instead of that, you will end up taking equivalent annual benefit and make the same comparison. What are some theory very quickly? What are the different factors that you will take into account? Of course, what is the capital cost versus what will be the resale value? For different time periods, the resale value will be different. Of course, with a period of time, the resale value keeps reducing. The operating cost over a period of time keeps increasing. Longer replacement cycles, as you saw for 6 years, the higher operating costs were higher. So with longer replacement cycle, the annual operating cost will also be higher, and the resale value will also keep going down. But at the same time, you are deferring the cash outflow of buying a new asset. There are also, in practical life, there are other factors which we have ignored over here, but taxation and investment incentives will affect your cost. Inflation, that same Activa of 1 lakh will not be 1 lakh in 4 years and 6 years. Finally, your resale value, that amount will also be considered, right? But what are the limitations of this analysis? This analysis has the limitation that in the 4th year or the 6th year, the Activa that you buy will be absolutely the same. But realistically, we know that technology keeps changing. Your mobile phone in 4th year and 6th year, your machine in 4th year and 6th year will not be the same. It will keep improving because technology is changing, inflation is changing. And finally, will you even need the machinery at the end of 4th year or 6th year is something that you don't know. Maybe you need the machinery at the end of 4th year, not 6th year, because you cannot predict the market conditions accurately in the future. This is also a problem because this model ignores demand volatility. But this is a bit of theory. From an exam perspective, you simply will have to calculate the equivalent annual cost, and you will have to give the recommendation as to which is the time period that you should go ahead with in terms of replacing. Okay. Topic number 3, capital rationing. See, in life, everything is limited and everything has limitations. I keep saying in my lectures, okay, resources are limited and everything in life has limitations. All your topic will have something called as limitations. Fine. So what happens is, if your capital is limited and you have a lot of positive NPV projects, right? You have a problem of plenty, you can invest in so many options, but then your capital is limited. So where do you invest finally? Sir, I will invest in the in those projects I will invest where I will get the maximum returns. Absolutely. But how do you compare? Every project has a positive NPV. The problem is there is a project where you invest 1 lakh and the NPV is 10,000. There is another project where you have to invest 2 lakh and the NPV is, let's say, 21,000. What do you do? You will say, sir, I will go with 21,000, but then you also have to invest double the amount. What do you do in this case? That is the problem. This is called as capital rationing. Now this happens mainly because of 2 reasons, right? One, of course, if the firm has lesser capital, but I would say there's a hard capital rationing and a soft capital rationing. What is a hard capital rationing? Where an external party puts a limitation on you that you cannot invest in XYZ project, you cannot invest in more than Z projects. And that external party could be, for example, the bank where you have taken the loan from. That bank will put a condition saying you cannot invest in more than 2 projects at one time, because they will say if you invest in more than 2 projects, your attention will get divided, the risk will get higher. That is called as hard capital rationing. But there is something called as soft capital rationing, where the management is very self-aware. They say that we know if we invest in more than 2 projects, then we will not be able to do justice to these 2 projects, and hence this is called as soft capital rationing. You can expect this either in a theory question for 3 marks, but more importantly, definitely in a section A or B MCQ, where you can be given a situation and you can be asked whether this is a hard capital rationing or a soft capital rationing. Now, but how to still solve the problem? I did not answer that question. Sir, how to solve that problem? 1 lakh capital, 10,000 NPV, 2 lakh capital, 21,000 NPV, how to solve? There is something called as a profitability index, where what do? You will say what is the NPV of the project, you divide it by the investment. Essentially, in some way you can say what is the net return that I am generating, excess return that I am generating on the capital that I have invested. In my example, 21,000 divided by 2 lakh versus 10,000 divided by 1 lakh, this will be 1.05 versus actually, let me put it this way, this will be 0.15 versus this will be 0.1, right? This will be 0.1. So what do you, I would say this will be 105, this will be 0.105. So what do you do? What do you end up doing? You will say, sir, per rupee that I have invested, if I have invested 2 lakhs, remember, NPV is not just the return, NPV is the excess return over the cost of capital that you end up getting, because you've already discounted the cash flows at the cost of capital. So, sir, per rupee of investment, I am generating an excess of 0.105 rupee, but over here I am generating an excess of only 0.1, and hence I should choose project A over project B. Or if I have sufficient capital, let's say if I have 2.5 lakhs of capital, sir, first invest 2 lakhs over here, then invest 50,000 over here. Now, what can I do? There is 2 types of scenarios. One scenario is if the capital is divisible. If the capital is divisible, the investment is divisible in the sense, which means if you have 2.5 lakhs, you go with 2 lakh first year and then 50,000 over here. But there is an option. You go with only half an investment. Let me give you another example. Can you buy half a share in the market? When you go to the stock market and you go to buy, you will have to buy at least 1 share. You cannot buy half the share, which means it is indivisible. It is indivisible. But when we talk about mutual funds, mutual fund units are divisible. You are able to subscribe mutual fund units in 0.1. Let me give you another example. Let's say if you have to subscribe, let's say I give you 3 options. I give an option of FD versus mutual fund versus, I will say, an option of bond, where you can invest 1 lakh here, 1.5 lakh here, you can invest an amount up to 5 lakh over here. And then I say this has the highest profitability index, second is this, third is this. I have a total, this is first, this is second, and this is third. Once you have the profitability index, you will have to rank the projects. This is second ranking, assuming, okay, but I have total only of 2 lakhs, sir. go for 1.5 lakh here, deposit 50,000 here. But I will say I will need a minimum of 1 lakh if I invest in the bond. The bond company is not accepting 50,000. Minimum value of the bond is 1 lakh. I cannot invest 50,000 in the bond, in which case you have no option but to go for option number 3. If the projects are divisible, if I were to tell you that yes, you can subscribe in fractions, you can even subscribe a bond of 15,000, then yes, you will invest over here in the second category, second priority. But if the projects were indivisible, then what you do, you will have to find a trial and error, which combination, you will have to do different combinations of the projects, which combination gives the highest NPV, gives the highest NPV. So essentially there is three categories of questions that you can expect. Three categories of questions. Number one, where the projects are divisible. If the projects are divisible, then you don't have to absolutely worry. You simply go with the ranking. You rank the projects, and then what you do is you simply put a fraction in the priority. You go for the first project, give the capital that it needs, and then whatever the remaining capital is, you go for the second. If you still have more capital, you go for the third, but you can invest in fractions. What if the projects are indivisible? If the projects are indivisible, then what you do is you do a trial and error method. Where you try different combinations, of the projects and see which combination gives you the highest positive NPV, highest total return, and you go for that combination. Let's say if it is project A, B, C, D, then if A and C in total give you a higher return, then you go for A and C even if B was ranked as 2. And number 3, there could also be a scenario where projects are mutually exclusive. When projects are mutually exclusive, which means if you undertake project A, you cannot undertake project B. Just read the question carefully in exam, in which case the combination of project A and B cannot work. You have to consider the approach will be same as point number 2, but the only thing that you will have to consider here is you cannot make the combination of project A and project B. You can make any other combination except for this combination, and you will still go with the same approach. What was the approach? You will do the trial and error. You will see where is it that you are making the maximum return, and that particular case you will have to end up going with. Okay, so very quickly, for divisible projects, calculate the PI. What is PI? PI is the profitability index for each project. Then you do the ranking. Then you keep funding as per the ranking until the funds are exhausted. And then finally, even if the final project cannot be funded, you undertake the fractional amount. This approach will maximize your total NPV. You have to make sure you maximize your total NPV, because why? You are the future CFO, and your aim as the future CFO of a multi-billion-dollar company is to maximize your shareholders' wealth. And if you have to maximize your shareholder wealth, the best way is to maximize the NPV. Okay, the second option is indivisible projects. Indivisible projects will be if you cannot invest in fractions, if a project must be entirely accepted or rejected and partial investment is not possible, you have to see all the possible combinations, calculate the total NPV for each combination, and then select that combination which generates the highest possible NPV. Okay, now I'm not solving the sums, but I'm just showing you the structure and putting, I would say, numbers to what I just explained very quickly. What do we do with the lease and buy option? I told you, you calculate the NPV cost for the lease option. What is the lease option? Where there is a cash flow. So there are lease payments from year 1 to year 4, and then there will have to be a tax benefit for those lease payments, but the tax was in arrears in the question. The tax was in arrears in the question, paid in arrears 1 year. Remember, paid in arrears 1 year means if the lease was for first year, even if it is paid in year 0, it was for first year, then the tax benefit comes in second year, and hence the tax benefit will be year 2 to year 6. And then you will find the net present value. These two will be cash outflow, and this will be of course inflow, because a tax relief means assume that the government is giving back money because of the expense that you have charged. Okay, But when you go for buy option, there'll be a cash outflow when you buy the asset, and then every year you'll keep getting the benefit of depreciation tax benefit, which is the tax relief on the depreciation, which again year 2 to year 5, remember, tax relief is something that you get for all the years except for the year when you actually sell the asset. In the year where you sell the asset, it will be a balancing charge or balancing allowance, as the case may be. Balancing allowance is if you have sold the asset at a value lower than your WDV, written down value, and balancing charge is if you have sold it at a higher value, then there is a profit that you've made and you have to pay a tax. In this scenario there is going to be a balancing charge. Okay, so here you have to calculate the NPV, and as you can see, the NPV is lower. Both are negative NPVs only because both are costs, but the option where the lower negative NPV, you have to go for that option, which is the buy option. And please do not forget to write such a recommendation that I am going for the buy option. Why? Because the lease NPV is lower than the buy NPV is lower than the NPV of the lease option. So that is option number 1. Now, or rather say, I would say concept number 1. Second concept we discussed was the replacement cycle. So in exam, you will be given such a table where you say if you replace in 1 year, the annual cost, this is annual operating cost. Annual cost will be 80,000, 1,10,000, 1,50,000, and the trade-in value, which is nothing but resale value. Resale value, as you can see, first year will be the highest, then it keeps reducing, right? So what you do is for each of these options, 1 year replacement cycle, what is your total NPV? Of course, cash outflow. When you buy the asset, the same 5 lakh is the same across all the 3 options, but what differs is your operating cost over here will be only for 1 year. Over here the operating cost will be for 2 years. Actually, you'll have to read the question carefully. In this case, this is year 1 operating cost, this is year 2 operating cost, this is year 3 operating cost. But if the question says in case of a 3-year replacement cycle, my annual operating cost is this, then the same amount you'll have to apply for the 3 years. But ideally in exam, you will have to say first year operating cost was this, then second year was incrementally higher, third year was incrementally higher. So in case you go for a 2-year replacement cycle, you consider operating cost for 2 years. For 3, of course, you consider for 3 years. You have to consider the cash inflow of the resale value. You finally find out the NPV, and then you say, again, this was the cost. Which option has the lowest NPV? Which is that option? Option 1 has the lowest NPV. So the answer, or okay, no, this does not end here. This does not end here. Over here, if you remember, EAC was what? You should not just find present value. You will have to find the NPV, but you will have to divide it by the annuity factor. You divide it by the annuity factor. For option 1, when you divide it by the annuity factor, it is 2,39,973. Option 2, when you divide by the annuity factor for 2 years. What is the discounting rate that is given in the question? Discounting rate that is given in the question was cost of capital 12%. I will just show you 12% for 1, 2 and 3 years. Okay, so for 12%, what is the annuity factor? For 1 year it is 0.893, for 2 years it is 1.69, 3 years it is 2.402. Okay, so what you will do is now divided by the annuity factor. As you can see, for first year it was 0.889, for 2 years the annuity factor is 1.69, for 3 years it is 2.40. There is some rounding of effect. When you calculate, you can either take the values directly from the annuity table, or you can calculate it using the calculator. And then what you do is calculate the EAC for the respective 3 years. Where is the EAC the lowest? If you see, the lowest EAC is for option number 2, and hence you will provide a recommendation in the examination that you have to replace every 2 years. Why? Because your negative NPV is the lowest, your net cost is the lowest in option number 2. Option number 3, or rather I would say concept number 3, which is if you have a 5 lakh budget, you have 5 lakh capital, and you have 5 projects to invest in, each of these will have an NPV. Like I told you, you will have to calculate a profitability index. What is profitability index? Over here, 60,000 divided by 2 lakh, which is 0.3. Each of these will have a profitability index. Then what you do, you will have to put a ranking. Over here, sir, but this ranking is the same, it is tied. Okay, first rank, then you will have to put second rank, then you will have to put third rank, and hence you keep investing in the same order. First rank you invest 3,50,000, you are total 5 lakh, you invest 3,50,000 in these two projects because they were rank 1, and then remaining you invest in the second rank project which was R, but you invest only 50%. If you invest only 50%, then you will consider NPV also only 50%. 50% of 72,000 is 36,000, then the total NPV is 1,41,000, and make sure that the cumulative amount equals to 5 lakh. Why 5 lakh? Because 5 lakh was your budget that was given in the question. In case of divisible projects, there is no capital that will be left. Okay, now what if the projects were indivisible? Then you will consider options PQS, PR, QR, QST. What is the total investment across all of these options? Remember, the total investment cannot exceed 5 lakh. 5 lakh is the total budget. You cannot spend more than what you have, but you can spend less. It is okay to spend only 4,50,000. Then what you do is you calculate NPV. How do you calculate NPV? Let's say for option number 2, which is PNR, what will you do? You will say 60,000 plus 1,30,000, or rather 60,000 plus 72,000, which means 1,32,000. 1,32,000 is the total return, which is higher than all the other options. So you will go for that option which has the highest NPV. Okay, now if I was to tell you in a third example that two projects are mutually exclusive, X and Y, you will create all the other combinations except project X and Y, and then again you follow the same methodology as the previous one, and you say which option has the highest NPV. Even if X plus Y has the highest NPV, that cannot be considered because these projects are mutually exclusive. Okay, you can quickly take a look at the key takeaways and key formulas. I am moving ahead to the next chapter. I know this seems like a very quick bullet train, but that's how revision will have to be, and only then you will be able to very quickly revise. And for those of you who are watching, it will be helpful if you can just say if you are with me and you are able to understand everything. If you can just put it in the chat box, and if you have any questions, I will just wait for a minute. If there is absolutely any questions, please feel free to put it in the chat box. I will wait for 30 seconds. I'll just take a sip of water until you all write on the chat box. If you are with me and if you have any queries, absolutely please let me know, and then I will go ahead and resume the next chapter. For those of you who are watching, it will be helpful if you can very quickly just mention if you are able to understand, and if there is any query so far, post which I will go ahead with the next chapter. Sounds good. Let me go ahead with the next chapter. See what happens in case of an investment appraisal. You will have to take an assumption, right? Sitting today, you are assuming, you are forecasting, okay, my year 3 cash flow will be X, okay, my year 4 cash flow will be Y, and so on and so forth. But can your assumptions go wrong? Absolutely, sir. Someone would have invested in a machinery in 2018 thinking I will earn XX dollars revenue in 2020, and then suddenly COVID happened, right? There is always a risk and uncertainty. As I am recording this video, there is a war that is ongoing between Iran, Israel and the US. So this again is a risk and uncertainty, right? So what do you do? How do you evaluate investments? How do you make sure that you are appraising the investments in a manner in which this risk and uncertainty is taken care of? Okay. But first of all, what is the difference between risk and uncertainty? It is an important theory question, can be asked between 3 to 4 marks. Please do read. What is the difference between risk and uncertainty? Risk is quantifiable. You know that this is a risk that can play out. For example, you know that there is a possibility of a recession playing out. There is always a probability of a recession playing out. But COVID was an uncertainty. No one even knew what COVID is until it came into picture. So uncertainty is not quantifiable. Risk is something that is an outcome that can be thought about. That is something that is quantifiable. Okay. What are the key areas of concern? What is your accuracy? What is the reliability of your estimates? What is the probability that you assign? And then finally, how do you choose your appropriate discount rate? So these are the different methods. These are the different methods that you use to deal with risk and uncertainty. We will go ahead with a few methods in this chapter. If there is risk and uncertainty, how do we still make sure we end up evaluating investments in a manner where our risks are taken care of? So Option 1 is sensitivity analysis. What does this mean? See, when you calculate NPV, there are a number of variables. Just yesterday I told you there is a hero, there is a villain, there are two side characters, right? So when you do the NPV calculation, so what happens is you'll have a revenue, you'll have a variable cost, you'll have a fixed cost, you'll have a taxation, you will have a residual value, you'll have a tax rate, you'll have you'll have a discount rate, you'll have so many variables which affect your answer on the NPV. The question is, what sensitivity analysis helps you solve is, what is that one variable? What is that one variable that your NPV is most sensible to? If I change the volume, by how much will my NPV change? If I change the selling price, by how much will my NPV change? If I change my fixed cost, then how much will my NPV change? So this is what is called as a sensitivity analysis. Why they do it is to understand which variables are most sensitive in terms of your final answer of the NPV. Okay, so the way we calculate it is super simple. What you do is you consider the NPV in numerator, divide it by the present value of cash flow of the relevant variable. Example, if I am understanding what is the sensitivity to sales, I will just calculate the present value of sales and then I will do NPV. NPV as I calculate normally, I will calculate normally, and then I will divide it by the present value of sales. Whatever that percentage is, let's say 20%, it implies that my sales will have to go down by 20% for my NPV to become zero. For me to start making losses, my NPV, or rather my sales, will have to go down by 20%. If it was to be variable cost, then I would say what is the present value of the variable cost, or let's say if it was fixed cost, I will say what is the present value of the fixed cost, right? And then my denominator changes, I will say what is the present value of the fixed cost. If this answer is 13%, then I will say my fixed cost will have to increase by 30%. Cost of course has to increase for my profits to go down, for my NPV to come down, my cost has to go up by 13%, and only then I will start making losses. Till that point I am sorted. So you will calculate sensitivity over here. This is a rental income, so income, annual cost, there is a sensitivity 167%. So the cost has to go up by 167%. Cost must increase for NPV to become negative. The rental income has to decrease by 29.9% for the NPV to become negative, and so on and so forth. What is its sensitivity to initial investment to the selling price? And again, it is super important to put an interpretation. There is always 1 or 2 marks for this interpretation. What is that one variable? That the NPV is most sensitive to? There are certain advantages and limitations. You can pause and you can quickly read. I am not spending time on this for now. Then the next approach is an expected value analysis. Let's assume there are 3 scenarios, right? There is a scenario where the economy booms, right? There is a scenario which is a normal scenario, and there is a scenario where let's say there is a recession in the economy. Alternatively, one always says, right, there is a bull case, which is a higher case, trend case. Then there is a normal case, which is called as the base case, and there is a bear case. So there are always 3 such cases. What is your cash flow changing? Of course, when I say if the market is great, if the market is booming, then in that case, if the market was booming, then in that case my sales will be so much more higher. But if there is a recession in the economy, my sales will of course go down, right? So you will have to calculate what is the cash flow in each of these scenarios and what is the probability of each of these scenarios occurring, and then you have to multiply the probability to the cash flow, the value of that outcome, the NPV of that outcome, and then the sum of this, which is nothing but the weighted average all of these outcomes, is your expected value. That is your expected NPV, which you have to consider to evaluate your project. You will not evaluate your project only on the basis of recession or only on the basis of boom, or only on the basis of a normal scenario. You will have to calculate an expected value, which means that there's an expectation that you will end up making this much profit. Now the one important conceptual point is, and can be tested in MCQs, EV is a long run average, not necessarily the most individual outcome. So if you are making an action and you are keep making it every week, every day, every year for indefinite period of time, then in that case expected value suggests the long term average. But if you are taking that activity only for one period of time, then for one period the risk is very high. There could be only a boom scenario or a recession scenario, right? But if you are taking it over a long term, then EV suggests the long term average. Okay, again, which project do you choose? The one which will have the highest expected value because that suggests the highest profit. Okay, now you should read all of this as well. So the example is, let's say a logistics company, there are two routes, it is evaluating between two routes. Okay, it is evaluating between two routes. There is a probability of three scenarios: rapid growth scenario, stable scenario, decline scenario. How do you find the expected value? Probability of rapid growth into probability or into NPV of rapid growth for urban route, similarly for stable demand, and similarly for decline. Then the total of all of these three, which is nothing but the weighted average, is something that is the expected value. So the expected value for the urban route is 2,27,000. As you see, that 2,27,000 is none of these three values, and yet 2,27,000 is the answer, which means over a long period of time the expectation is that you will have a positive NPV of 2,27,500. Similarly, the answer for rural route is lower. So if you were to choose between the two, I will say you go for the urban value. Why? Because the probability or the expectation of you making a positive NPV is much higher for the urban route versus the rural route. Okay, but having said that, one thing that you should mention is that in rural route, in all the scenarios you are making a positive NPV, but in urban case the variability of an outcome is higher, which means there is a possibility of making negative NPV also, but then if the market is great, you make a super high return. So the variability, the outcome range, the range is much higher. 4,50,000 to negative 1 lakh is 5,50,000, versus for rural the range is very small, 2,80,000 and 5 lakh, so the range is much smaller. So while you will end up selecting urban route, you have to put this important caveat that option of urban route is still riskier because there is a wider range of outcome. In example 3, you can expect such a question. What does the question say? The question says you can stock either 5,000, 7,500 or 10,000 units, and at the same time the demand can be either of these 3 points. The probability is this. If you end up selling, the profit is this. If you have it in stock but you don't end up selling, is the loss per unit will be pound 2. But if you don't have in stock and you don't end up selling, then there is no loss. Of course, you have lost some profit which you could have made, but there is no loss. You will make a loss only if you have something in your stock. So how do you take the decision? You say, if I was to have 5 lakh stock, 5,000 stock, and if the demand was 5,000, I will make profit on 5,000. Again, in these two cases also, even if demand is higher, I have only 5,000, I will make profit only 5,000. But what if I have stock of 10,000? If I have stock of 10,000, great, I will make profit of 10,000 if the demand is 10,000. But what if the demand is lower? What if the demand is only 5,000? Then I will make 5,000 pay profit. But on the other 5,000 that remains unsold, which I had in the stock, I will end up making this loss of $2. So what is my net profit? And then you multiply it by the probability. The NPV, the scenario which has the highest NPV, which is over here option number 2, you should end up going for a stock of 7,500. Should you use expected value in this scenario? Yes, because this is a weekly demand. You are going to do the business for years altogether. So over a long term average, it is better to have a stock for 7,500. In some weeks the demand will be 5,000, in some weeks the demand will be 10,000, but over a long term, keeping a stock of 7,500 will be giving you the highest amount of leverage. Okay, now what are the advantages and disadvantages of expected value analysis? You can pause the screen, quickly take a look and read. I am going ahead to the next concept, which is joint probabilities. For mutually exclusive outcomes, if you have to find the joint probability, let's say the probability of India winning its match today versus West Indies versus the probability of me taking another life today. These are two very, very unique probabilities. these are unrelated, and hence the probability will be probability of A into probability of B. But if these were mutually exclusive, which is either X happens or Y happens, which are mutually exclusive, then the probability of A happening or the probability of B happening, which is, if I was to say what is the probability of either India or South Africa winning the World Cup, will be probability of India plus the probability of South Africa. And if they are non-mutually exclusive events, then it is probability of A plus probability of B minus the common probability of the two. So what do you do in exam? Again, you will be given such probabilities for the cash flows. There are two options. There is one option where you independently multiply these probabilities, find the expected value for year 1, and then you find the expected value for year 2, and then what you do is then you just simply add the two. That will give you the NPV. The second option is you create four scenarios where you say there is a possibility that year 1 is 300,000 and year 2 is 400,000. Possibility 2 is year 1 is 300,000 but year 2 is 250,000. Possibility 3 is year 1 is 200,000, year 2 is 400,000. Possibility 4 is year 1 is 200,000 and year 2 is 250,000, which is these four probabilities that are mentioned over here. You will have to find the joint probability. In this case, these are independent events, and hence you will multiply the probability. Needless to say, the probability will have to equal to 1. Okay, because probability has maximum probability has to always be 1. Then once you found this, you will apply the discount factors. For year 1 you will find a discounting factor, for year 2 you find a discounting factor, you find the NPV for each of these scenarios, and then you find the joint probability. This method is a more suggestible method in examinations, and I'll tell you why. In exam, if you are only asked expected values, then you can use the previous method which I suggested, which is the expected value of year 1 plus expected value of year 2. But in exam, you will also be asked the probability of having a negative or a positive NPV. What is the probability of a negative NPV? It is 0.24. What is the probability of a positive NPV? It is a total of these three, which is 0.76. What is the probability of a 0 NPV? Is any of these options 0 NPV? No, and hence the probability of 0 NPV is 0, which is what is given over here. This would have not been possible to answer if you would have gone with the first approach. So in exam, you have to make such a table, make sure that the probability equals to 1, carefully calculate. You have to not just use these cash flows, but you have to use discounted values of these cash flows. You have to add these, and then you have to find NPV. Of course, needless to say, you will also have to consider the investment that is required of 500,000. In all of these cases, do not forget to reduce, do not forget to subtract from NPV, or basically you do not forget to consider the cash outflow at year 0. Okay. Finally, there is a discounted payback period method. Remember, when we had studied the payback period method in the earlier chapters, we had discussed that payback period has a significant flaw, that it does not consider the time value of money. To tackle with this flaw, this concept of discounted payback period incorporates the time value of money. What does it do? It simply says, okay, what I will do is I will discount the yearly values, I will find the present value of yearly values, and then I will do the same thing, which is in how much time will I recover the present value, of the investment that I have made. So what you do is you take the cash flows, you find the discounted cash flows, you make it cumulative. The year in which it becomes positive is the year of recovery. So 2,500 over here, I will divide it not by 3 lakhs, but I will divide it by 2,19,300. This is X number of whatever number of months it is. Okay, or I would say, sorry, 2,16,000. Had to recover 2,16,800 from the previous year. Outstanding from the previous year is 2,16,800, and in this year I have earned 2,19,300. What is the number of months? You should ideally answer in number of months. Ideally answer in number of months also, I would say, which is you. And remember, number of months you have to always round upwards, which usually in this case of course will end up being 3 years. Quickly read through this. Now the risk adjusted discount rate, see, there will be discount rates, but if there is a risk in the project, you know there is a risk, then what you do is you will apply a higher discounting rate, you will apply a higher risk premium, and your discounting rate will be higher. Remember, there is a inverse correlation between the NPV and the discounting rate. The higher the discounting rate, the lower the NPV. So you are saying, I will take the worst possible outcome, or I will apply a risk premium if the project has a risk. I will take a higher discounting rate if there is a risk, and which means it will tell me the lower NPV, and if that low NPV is still positive, I will go ahead with the investment. So this is one way to tackle with the risk, which is you add some risk premium to the discounting rate. There is a concept of simulation analysis as well, which says that you have to select random values for probability distribution, and then for each value you have to keep calculating NPV, and then whatever your range of outcomes will be, basis that you have to calculate what is the probability of you having a negative NPV. If that probability is significant, you don't take the project, but the probability of having a negative NPV is insignificant, then you still go ahead with the project. Okay, but however, in exam you will not be expected to perform any calculations. This is just a theory concept that is given over here. You can pause and you can take a quick look. Okay, in exam you can expect multi-method analysis, which is you can evaluate basis sensitivity analysis, you can evaluate basis the expected value rule as well. Okay, this is the comparison of techniques. Here are a few examination techniques, and of course summary of key formula. You can pause, you can take a screenshot, and of course you can take a print as well, so that you can quickly revise 1 hour before the examination. So we are finally done with one of the most important topics of this entire subject, which is investment appraisals. Now we should quickly take a 5-minute break, not more. While the timer will show 10 minutes, we will take a break of only 5 minutes. We'll start at sharp 5 minutes from now, and we will resume with the next most important topic, which is risk management. So see you absolutely soon in 5 minutes. Welcome back. Let us quickly get started with the next chapter, which is foreign exchange risk management. Risk management, like I have said earlier also, this section is absolutely important from an exam perspective. There are two parts to this section. There is foreign exchange risk management also, and then there is also interest rate risk management. What is foreign exchange risk management? First of all, what is foreign exchange? I'm sure most of you know what is foreign exchange, but why is there risk? There is a risk because foreign exchange rates keep changing. Now let's take a scenario. Let's assume that you have to, let's say, pay ACCA fees, right? You're sitting out of India, you have to pay ACCA fees in 3 months from now. So it is a payable, it is a liability for you. Okay, you have to pay the fees in 3 months from now. What are you scared of? What are you scared of? You are scared that the pound will strengthen and the rupee will weaken. You are scared that the sterling pound will appreciate and the rupee will depreciate. So you are scared that the reliability will go up, it will appreciate. On the other hand, if you had to receive an amount from abroad, what would you have been scared of? You would have been scared of, if let's say you would have been having to receive an amount from the US, what would you have been scared of? You would have been scared of, if you have to receive, then your amount in dollars would have been the asset. What will you be scared of? You will be scared of that asset going down, which means the foreign currency depreciating and your home currency appreciating. So this floating exchange rate creates that uncertainty. What is the floating exchange rate system? Which means the exchange rates keep changing basis demand and supply. They are floating, they are not fixed. But few countries also follow the fixed exchange rate system, that is between two currencies they have their currencies pegged to another currency requiring central bank intervention. There is second one which is free floating and third one is managed floating, which means it is a floating currency, but if the movement is too fast, too wide one way or the other, then the central bank will intervene to control the extent of the movement. A lot of times you would have heard that the dollar has strengthened a lot, rupee has weakened a lot, so sometimes RBI intervenes to manage that rate. There are three types of foreign exchange risk. First is there is a transaction risk, the example that I gave, which is if you have to pay ACCA fees in 3 months from now, then in that case it is a transaction risk. It is a risk that the rate of pound is to rupee will change between today, which is the transaction date when let's say you registered for ACCA, and the settlement date, which is let's say you want to pay. Okay, so this is the transaction date. Let's say if an exporter is selling goods, he would have sold goods when the dollar is to rupee was 90. What is he scared of? He's scared of that he sold basis 90. What if the dollar goes down, it goes to 88 or 85? Okay, that is transaction risk. There is an economic risk. What is economic risk? Economic risk is if let's say dollar goes up, okay, and you are an exporter from India. If dollar goes up, what happens? You will say, okay, if I'm an exporter from India and if the dollar strengthens, then rupee weakens. If rupee weakens, then Indian goods become cheaper for foreigners, and hence there will be more demand for Indian goods. For exporters it is a benefit, but sir, for importers, those who are importing from the US, there will be a problem because the US goods have become more expensive given that the dollar has strengthened. So this impact is nothing but the economic risk impact. There is theory given exactly what I had explained to you. You can read this. And the third risk is the translation risk. What is the translation risk? This is more a theoretical risk, less of a real risk. What is the risk? If you are a company based out of UK, if you have a subsidiary in Australia, then the exchange rate of pound is to Australian dollar changing will change the profits. See, while the Australian subsidiaries profits do not actually change, but between the day of the sale done by the Australian company and the date on which you make the books of accounts, if the exchange rate changes, then the profit will go up or down basis the change in the exchange rate, and you are scared of that. Why? What if it goes down? This is nothing but an accounting risk, a translation risk, when you translate the financial statements of a subsidiary to that of the holding company. That is the translation risk. But this is less of a real risk, it is more a paper based exercise. Okay, so these are the three risks: transaction risk, economic risk, and translation risk. Now when you trade in currencies, there is often a quote given. The quote could be 1.524 to 1.525 dollars per pound. What does this mean? Always remember, by the way, the thumb rule is, while I will also explain you with a memory aid or mnemonics the way you can remember, but always remember that you, or rather the bank, will always try to profit after you. What does that mean? That if you want to buy the pound, they will sell you the pound at a higher rate. But if you want to sell the pound to them, then they will buy the pound from you at a cheaper rate. They will buy the pound from you at a cheaper rate, but they will sell the pound to you at a higher rate, right? So always remember that bank will make profits. They will always buy cheaper and sell expensive when we talk about the base currency. This is true when we talk about the base currency. Okay, remember, in whichever scenario, just imagine yourself in the shoes of the bank, or imagine yourself in the shoes of the hi Kriyank, in the shoes of the customer of the bank, and just imagine if you are buying from the bank or you're selling from the bank, and think as to in what scenario is bank going to make a profit. Good evening. Okay, so, and the memory aid that I can tell you is, in this equation, wherever it is, let's say in case of rupee dollar also, when it is $1 is equal to 90 rupees, the dollar is the base currency. The dollar is the base currency because it is it is rupees in terms of dollars, 90 rupees per dollar. That per dollar means that the dollar is the base currency and rupee is the counter currency. Over here in this situation, dollar is the counter currency. The memory aid that I can give you is that there is hello and bye bye. What is hello? Bank sells what? Bank sells the counter currency. If bank was to sell you the dollar, it sells the counter currency. It will sell you the dollar at the lower rate, and it will buy the dollar at a higher rate. If it buys the dollar at a higher rate, which means it is selling the pound at a higher rate. If it is selling the pound at the higher rate, which means you are buying the pound at a higher rate. Okay, so like I told you, there's two ways to remember this. The logical method I explained to you, and there's a memory aid also, which is bank sells low, which is hello, and bank buys high. But buys what? The key is, this is for counter currency. Bank buys high the counter currency, which is buy. Okay, what are the causes of exchange rate fluctuations? Multiple causes, as you know, the most basic is demand supply. But how do you explain demand supply? What is the demand for? The demand is for trade, and etc. So generally for trade, and then for capital movement. So balance of payments of imports and exports, where supply may exceed demand. If supply exceeds demand of a currency will depreciate. If demand is more, then the currency will appreciate. It also happens in case of capital movements, where one country, if it has a higher interest rate, it will attract, the higher interest rate country will end up attracting more investment. If it is attracting more investment, then the currency of that country appreciates. It also happens in case of political stability, like in current scenario, if there is political instability in Venezuela, their currency will go for a toss. Or let's say if there is political instability in Iran, their currency will go for a toss. And finally, in case of inflation as well. Next concept is a concept of purchasing power theory. What does this concept of purchasing power theory say? It says that eventually, even if there is a difference in exchange rates, there will have to be, let me explain. Let's say if pizza is available at 450 rupees in India, will it be available at $450 in the US? No, the pizza will be available at ideally 450 divided by 90 rupees, which is $5 in the US. They say that the pricing eventually has to match between the two countries. Why? Because if the pricing in the two countries does not match, if the pizza was cheaper in the US, then we will ideally go to the US and buy. Of course, for pizza it's a bad example because it is a perishable item. For all the non-perishable items, you will go ahead and buy from the other country if those goods were cheaper. And hence the exchange rates work in a manner where exchange rates are getting balanced by the inflation rate, the relative inflation rates. If my price of the goods, pizza in India gets expensive by 10%, but in US it gets expensive only by 4%, I will go to the US and buy. But then what happens is the exchange rates offset each other. The dollar will increase to compensate for that remaining 6%. And how do you explain this? You will say, what is the future spot? What is the expected future spot rate? What does this mean? If you are sitting today, then the exchange rate today is called as S0, which is spot 0. Then what will be the expected spot rate, let's say in 6 months time or in 1 year's time? It is nothing but 1 plus HC. What is HC? HC is the counter currency. In my example, counter currency is rupee, and hence if rupee inflation is 10%, 1 plus 0.10 divided by dollar is the base currency, 1 plus HB. HB is the inflation rate in the base currency. So if that is 0.404, and you multiply it by 90, if 90 is today's spot rate, then whatever answer you get, you will say S1. In 1 year's time, the dollar and rupees expected spot rate is going to be S1, which is something that you find using this formula. But remember, if it is for 2 years, if it was for 2 years, if let's say this was for 2 years, then you'll have to square it. If this was for 6 months, then you will have to just consider, instead of 1.10, you will consider 10% into 6 by 5, which is 0.05, plus 4% into 6 by 12 rather is 0.02. So you have to consider pro rata for the time period. Limitations you can quickly pause and read through. The next theory is the interest rate parity theory, which says that if the interest rate is higher in one country, then people will start investing in that country. But then what happens when they will want their money back? The demand of the original currency will increase, and hence that currency will appreciate, this currency will depreciate. So they are saying, even if there is an interest rate differential, people will not be able to take advantage of that. Yeah, otherwise I will say, oh, if Japan has 1% interest rates, I can borrow from Japan and I can invest in India at 10% without any risk. I am making 9% profits. But that does not work that way. It will mean that the Indian currency will depreciate to that extent to compensate for that differential of 9%. The same logic as purchasing power theory, but except for the purchasing power parity theory. But over there we were considering inflation. Over here we consider interest rate. The formula looks very similar. The only difference is S1 is replaced by S1, which was for purchasing power parity theory. S1 has been replaced by F0. F0 here means a forward rate. What does a forward rate mean? Kindly bear with me for another 10 minutes until when we cover the concept of forwards. And like I said, H has been replaced by I. What was H? H was inflation rate, I is the interest rate. But the concept is quite similar, which means the country with the higher interest rates will always trade at a forward discount, which means it will depreciate. In my example, Indian currency will depreciate against the Japanese yen. And again the funda that I was telling you is 3 months or 18 months. If the time period is different, do not forget to prorata the interest rates, and then apply it in the question. This is the common mistake that people make, end up making. Okay, you can read this. Okay, I will just take 30 seconds and have a sip of water. In the meantime, maybe you can quickly read this. Okay. Now the next concept is remember the Burger formula that I had told you, which is the relationship between nominal and real interest rates, is the Burger formula, which is the nominal rate is nothing but the real rate into the inflation, 1 plus real rate into 1 plus inflation. So there is a four-way equivalence model, which is what was the difference in inflation rates? This was the purchasing power parity theory, remember, and this was the interest rate theory. What does the purchasing power parity theory explain? It explains the relationship between expected future spot rate and the spot rate. What does the difference in interest rates theory, which is the interest rate parity theory, explain you? It explains you the relationship between forward and spot rates. And what explains the relationship between the expected forward and the, I would say, the forward and the expected spot rate? This is the expectations theory. This is the four-way equivalence theory, which is nothing but F0 by S0 is equal to S1 by S0 is equal to the interest rate differential is equal to the inflation rate differential. Okay, this you should absolutely read, because this will help you check your answer in the examination. Okay, now the question is, why are we studying this chapter? Sir, we are studying this chapter because as the CFO of a future multi-billion dollar company, when we will be trading excuse me, when we will be trading in multiple countries and multiple currencies, we will also be facing the foreign exchange risk that we just spoke about. And hence, if we will be facing that risk, how do we mitigate this risk? How do we manage this risk is the question. Okay, what are the options to do that? The options are either you invoice in your home currency. If you are invoicing in your home currency, then it doesn't matter even if the exchange rates keep changing. Or second option is the easier option, do nothing. If the risk is smaller, it's okay to ignore, it's okay. The third option is leading and lagging. In my example of ACCA fees, don't pay it 3 months later, you pay it today itself, so that you are not exposed to the exchange rate risk. Or if you think that you have to pay, but if you think that pound is going to weaken and you'll have to pay lesser pounds, then you probably delay the payment and you have to make it lagging. But the issue is, it is always not possible, and this is speculation. It goes only on the expectation. You will lead the payment if you were to think that pound will strengthen. Then what you will do, you will pay it in advance. But at the same time, if you think that the pound was going to weaken, you will delay it and you will lag it. Okay, next option is matching receipts and payments. See, a lot of times when you buy from a country, or when you buy, let's say you are buying from you are a company who is importing from the US, it is quite possible that you are also exporting from the US. What you will do is, you will make sure, or let's say you exported elsewhere also, but the denomination was dollar, make sure, or try to make sure as much as possible, that your receivables and payables offset each other. If they are going to offset each other, then in that case your risk has been minimized, if you offset your foreign currency receipts against the payments in the same currency. Next one is, if you are a company, with different subsidiaries in different parts of the world, then in that case you will be probably receiving from some countries and you will be paying to some countries. So try to net the intercompany balances before you end up paying, so that the number of transactions are lower, the transaction costs can be saved. Next option is, you directly maintain a bank account in the foreign currency and all your receipts and payments flow through in that. And finally, you match your foreign assets with foreign liabilities. So for example, if you have a foreign subsidiary, US subsidiary, if you are a UK company, you have a US subsidiary, then you also have a US loan which you take to invest in that US subsidiary. Then in that case, even if US dollar was to weaken and the value of your asset was to go down, the value of your liability will also go down. Then in that case, you will still have a lesser amount of risk. Now, how to manage risk the other way? Of course, one is, these are simpler approaches, but if you were to actively manage the risk, you will go for derivative instruments. What are these derivative instruments? One of these instruments is a forward exchange contract. What is a forward exchange contract? Simply put, you go to the bank and say, bank, I need to pay my ACCA fees in 3 months from now. Please tell me the rate today. Please fix the rate today for me. that I will pay to you in 3 months, and then I do not care what the actual rate is in the market. I will pay on the basis of the rate that we fix today. Okay, that is the forward exchange contract, which is where it is a binding agreement. It is a binding agreement. You have to comply with the agreement to buy or sell the currency. In our example, where I used the example of paying ACCA fees, I will say the scenario where you have to pay ACCA fees and you have to buy pounds, you will take the agreement today. You are agreeing today at a rate for settling in future. These are customizable contracts, and then you exactly know what is the amount that you have to pay. And then even if the currency pound strengthens or weakens, it does not matter to you because your rate is fixed. Okay. The second instrument, the second derivative instrument, the second way to manage your risk is the money market hedge. What is this? Now, very logically think, if you have to pay, let's say, the ACCA fees, I'm using this example because it is relatable to you. You can use an example of an importer or an exporter also. Okay, let's use a different example. Let's assume that you are an exporter. If you are an exporter and you've exported goods to the US, you have to receive a payment in dollars. Okay. Now, if you have to receive a payment in dollars, what are you fearing? You are fearing that your asset, which is dollar, your asset will go down. Your asset will go down. If you fear that your asset will go down, you have to create a position where you are set to benefit if the asset if the dollar goes down. What is the position where you will benefit if the dollar goes down? The only position can be where you create a liability in dollars, and if the dollar goes down, the value of your liability goes down. So what do? You take a loan in the US dollars. You take a loan in the US dollars. You take a loan in the US dollars in such a manner that, and for such period that when you actually end up receiving the dollars from your customer, you pay that amount back to the bank where you had borrowed. Okay, sir, then what do I do with the amount that I borrowed today? You will convert it to your home currency today itself, because today's rate you already know. You are eliminating the exchange rate risk. You will convert it at today's rate, and then you will invest the same amount. Assume you will still get the money after 3 months only, as you would have to have a like-to-like comparison. You invest the same amount of money in your home currency at the deposit rate. Remember, when you borrow in the US to create a liability versus your receivable, you have to create a liability. If it is an asset, you have to create a liability. If it is a liability, you have to create an asset. Okay, so basically you have to create the opposite position. So if you are borrowing in the US, you have to use the US borrowing rate, and then if you are converting and then investing in India, you have to use the Indian deposit rate. Okay, now if the scenario was reversed, where you are an importer and you have to pay in 3 months, if you have to pay in 3 months, then there is a liability. If there is a liability, what do? There is a liability. If there is a liability, which is the scenario which I am discussing, which is where you have to make a payment. If it is a liability, you create an asset. So you invest an amount. Today itself. You pay the amount, that ACCA fees example that I was giving. You pay the amount today itself. So you deposit money, and you deposit money in such a manner that the amount that you've deposited is lesser, but in those 3 months it becomes equal to the payment that you have to make. So payment divided by 1 plus the foreign deposit rate, because now you're depositing in foreign, that amount you have to deposit. Now if you have to deposit in the UK, then what does that mean? It means that you will have to put money from India to the UK. You'll have to send money today. If you send money today, then you'll have to convert. You'll have to buy the pound at today's spot rate, and then that amount, you don't have money today. If you had money today, you would have paid to the ACCA only. So you will go to the bank, you will borrow at the Indian borrowing rate, at the home borrowing rate, and then finally the amount that you will repay is the amount that you've borrowed plus the interest rate in 3 months. Okay, the memory aid over here is, if you have to make a payment, decide by borrowing. Always, if you have to make a payment, I have to make a payment, I don't have the money, I have to borrow, and hence decide by borrowing. What is decide by borrowing? Deposit in foreign currency, convert at spot, and finally borrow in the home currency. So deposit, convert, borrow, which is decide by borrowing. This is a memory aid in case of payment. And again, the other logical way I can explain you is, if you have to make a payment, it is a liability. You create an asset by depositing. To deposit, you have to first convert, and to convert, you have to first borrow in the home currency. Okay, steps would be, first, to calculate the present value. First, let's explain with an example. First of all, if you have to pay, if you are a UK company, you have to pay 720,000 US dollars in 4 months. You will invest such an amount which in 4 months will be 720,000. You will invest the amount where in US a deposit rate you will use of 4.5%. But you don't forget to pro rata for 4 months, because 4.5% is an annual rate. You pro rata for 4 months. So the 4-month pro rata rate is 1.5%. So the amount that you'll have to invest today is 709,000, which once it earns 1.5% interest, it will end up having a total amount of 750,000, which then you can use to repay your liability. But today you don't have 709,000, so what do? You will end up buying dollars of 709,000. You'll have to buy dollars of 709,000 through pounds. How many pounds do you have to pay? Now, what is the exchange rate that you use over here? You have to buy dollars. You have to buy dollars because you have to deposit in the foreign currency. You have to buy the dollars. If you want to buy the dollars, then in that case, if you are buying dollars, bank is selling you the dollars. Remember, sell low, bank sells at a lower rate to you. So bank will sell at the lower rate to you, 1.68, and hence this is the amount of pound that you need. Now, if you need this but you don't have the money, what will you do? You will say, I will borrow. So you will borrow at what rate? You will borrow at the home currency borrowing rate, which is 7.5. Do not forget to pro rata. This is then 2.5%. So you will borrow this amount. You will pay. Over here you will multiply. Over here you are dividing, because you are depositing. When you are depositing, always divide. When you are borrowing, always add, multiply, because you will have to pay interest. Okay. So the total amount you will have to pay is 432,000. Okay, that is the total amount. Now the option is, if you would have gone for the forward rate, then this is the 1.6740 is the number. So you would have had to pay 430,000 pounds, but you are going for the money market, you will pay the 432,000, which is the better option. If you have to make the payment, the lower option is a better option, and hence forward contract is cheaper. So you will go for the forward contract. But at the same time, if you had to receive funds, then you will go for the one option which will give you the higher amounts. If you have to receive, you do exactly opposite. You first borrow in the foreign currency. Why? Because if you have to receive, there is an asset in the foreign currency. You'll have to create a liability in the foreign currency. How do you create a liability? You will borrow in the foreign currency to create that liability. Now, if you have to borrow in the foreign currency, what do you do? What do you do with that money? You will bring it to your home currency. You will convert in the home currency, and once you brought it in your home country, you will deposit it in the home country at the home deposit rate. This is exact opposite of what we did in payment. What is the memory aid over here? Your memory aid for payment was what? For payment, it was decided by borrowing, which is deposit, convert, borrow. Here it is exactly opposite. It is borrow, convert, deposit. So borrow, convert, deposit will be busy depositing. If you have to receive money, you will receive money and you'll be busy depositing in the bank. So busy deposit is the memory aid for here. I'm not taking you through this example, but please pause and take this example. The only thing I will tell you over here is that once you borrow money in the UK, you'll have to convert, which means you'll sell euro and buy pound. You'll sell euro, then the bank will buy euro from you. Remember, buy. The bank buys the euro from you at a higher rate. If the bank buys the euro from you at a higher rate, it will buy at 1.1670. You can pause, you can read this question, because this is the exact opposite of what the payment option was. Okay, now in a scenario where you have to receive this much but you have to pay this much, of course you will hedge only and only the net amount. So you, in your examination, do not solve separately for this is 3.6 million. Do not solve separately for 3.6 million and 1.2 million. Please solve only for the net receivable of 2.4 million. Okay, after here the question is absolutely the same. In this case there is a net receipt. In case of receipt it was you have to be busy in depositing, which means borrow, convert. You have to first borrow, then you have to convert, and then you have to deposit. Compare it with the forward rate. You are getting more pounds in forward. you are getting. Remember, it is receive. So what is the better option? The better option is forward hedge, because you are getting more pounds today if you fix the exchange rate with the bank. Okay, so hereby we've discussed what? We've discussed the concept of forwards as well as money market hedges. Remember, again I'm reiterating that these are super important concepts from an exam perspective, from an exam questions perspective. Okay, now coming to foreign currency derivatives. What are foreign currency derivatives? There will be a futures contract, which means that there are standard contracts very similar to forwards, which is there will be a rate quoted in the market today at how much will a particular currency trade at a 3-month 4-month mark from now. It is very similar to forwards. The only difference is that it is not customized. Forwards were customized. You can go to the bank, decide an exact amount, but futures are not customized. They are very standardized contracts that are trading on the stock exchange. They have a fixed amount. You cannot trade change that amount. So the logic will be very simple. If you have to make a payment, in 3 months from now, you will buy the futures of that currency. But if you have to, for example, you have to receive pounds. Then what will you do? Is you will have to, what is it that you are scared of? You just have to think of that logic. If you have to receive pounds, then I am scared of pound going down. Then how do you make profit out of pound going down? You will be able to make profit after pound going down if you have sold today. If you sell it today itself at higher price, and then future, if it goes down, then you buy at the lower price. Basically, think of it this way. What if you've received that amount today itself? If you receive that amount today itself, you will sell that currency in the market. Just take that logic. If you receive the amount today, you sell it in the market, which means you are selling the futures, but your actual receipt will be at the spot rate of the future point, or the spot rate of the future point. That is the difference. In case of forward exchange contract, the difference was that your rate was fixed. In this case also the rate is fixed, but forward rate, you have to just consider that rate. Over here you have to consider two rates. What is the actual amount that the spot rate moves to, that actual receipt or payment, and then there will be a loss because you had sold at 1.82. now you'll have to buy at 1.88, buy it back. If you have sold, you have to square off the position, you have to buy. Okay, you have to buy it back, so there will be a loss of 1.82 minus 1.88, which is 0.06, and hence there will be a loss, but your net amount will be 1.82, which is the amount that you had logged in as per the futures contract. Very similar to forwards, the amount will not change, that amount will remain fixed, that amount will remain logged in. But having said that, it will be in two transactions. One is the actual receipt basis the actual future spot, and second will be the futures loss. In this case, if you were to make a payment, in dollars, what do you do? To make a payment in dollars, what do? You will assume you make the payment today itself, so you will have to buy dollars today, but buy dollar futures today. Now what happens if the dollar goes up? If the dollar goes up, then your payment increases, but if your payment increases, your future price also increases. If your futures price also increases, then you would have bought at a lower amount, you'll sell at a higher amount, so there will be a futures profit. So what happens? You make a higher payment, but then you will reduce the futures profit from the higher payment, and hence the net amount will be nothing but the rate at which you bought the dollar futures. You should probably see, this concept is very important. You should probably pause, watch this concept again, maybe watch it at a 0.75, and question practice is absolutely much needed. What I can help you with is concepts, but you will have to do practice, and there is no doubt to that. Okay, what are currency options? currency options, as the name suggests, there is an option but not an obligation. There is a right but not an obligation. Right to what? Right to buy or sell. If you have the right to buy a currency, right to buy a currency is nothing but the call option. Right to sell the currency is nothing but the put option. Now, if let's say you have to make a payment, then what happens? You want excuse me, if you have to make a payment, then you would want that you have the right to buy the dollars at a particular rate. You have the right to buy the foreign currency at a particular rate, but not an obligation. What if the foreign currency actually weakens? Then you have to pay lesser amount. Then you'll probably go and buy from the market instead of buying in the contract, because you have an option. But if the dollar strengthens, then in that case you will exercise the option. You exercise the option to buy it at the pre-decided rate. Okay, so it's a right, not an obligation to buy. Buy what? Buy is call or sell is put. Okay, but then there is a premium. There is an upfront premium that you have to pay, because unlike futures, here there is a flexibility. Futures and forward do not have any flexibility. Over here you have the right. If the actual spot rate is beneficial, you go for the actual spot rate. But if the options is beneficial, you go for the options. You don't go for the spot rate. But because of this flexibility, you are going to have to pay a premium. So there is an example where you have to receive $3 lakh. You have to receive $3 lakh, which means what will you do? You have to sell dollars to buy pound. You are a UK company. Once you receive, you will sell dollars and buy pound. So you want what? Either you want the option to be able to buy pounds, which is a call option on pounds, or you want sell option, which is put option of dollars. What is available in the question? We have a call option on the pound, which is available. We have this option, which is available. Okay, so exercise price is 1.55. Now remember, if you have to receive, then what are you afraid of? You are afraid of the receipt, which is your asset value going down. You are afraid of the dollar going down. If the dollar depreciates, then you are afraid. So what happens? Okay, your exercise price over here is 1.55. Two scenarios. Let's assume 1.48 and assume the scenario of 1.65. What happens if the dollar depreciates to 1.65? If the dollar depreciates to 1.65, then you are sad. Oh, my dollar has depreciated. I am getting lesser amount when I convert it to pound. Then in that case, why should I go for the spot rate? I will go for the option rate and I will exercise the option. But in the scenario where dollar appreciates, the dollar versus pound value actually goes down. In that scenario, you will be happy and you will say, I will not exercise the option, because 1.55 is a lower value that I will get in terms of pounds. I will go for 1.48, which means if I divide 300, or it is 3 million, not 300,000, divided by 1.48, compare versus 3 million versus 1.55, I will get more amount in pounds here. So I will go for the spot rate and I will let the option lapse. But in both the cases, you have to pay the premium. Effectively, there will be a table like this where you say how much is the actual market value at spot rate. You will be getting this much if it is 1.65 versus the option value was this much. The dollar has depreciated more, so you will much rather go for the option. You will exercise the option. What is your net result? Net result is nothing but this result minus the premium of 22,000. But in scenario B, the dollar has not depreciated, it has appreciated. If it has appreciated, you will be getting more pounds. Which is this math that I explained you. You will be getting more pounds. If you are getting more pounds, you will not exercise the option. You are getting more pounds from the market than from the option, so you will not exercise, you will let it lapse. Market is better than the option. You will let the option lapse and you will actually go for the market, but you will still have to pay the premium of the 22,000 over here. Okay, you can again pause, read again. You can read this theory also, the explanation also. Option basically means you will go for whatever is easier, whatever is cheaper, whatever is more beneficial from your perspective, whether market or option. You have the option to exercise or lapse. Make such a table in exam, it will be very, very helpful. Now one might ask, what to choose between forwards and options? See, if you are certain that the transaction is going to happen, then in that case please go for forwards, because these are binding contracts. But if you are uncertain that the transaction will happen, then go for options, because then you have the option. You are not under a compulsion, you have an option. Similarly, if you want to benefit from the actual market, if you feel, oh, what if the exchange rate moves in my favor, I want to take that benefit, then you go for the options, because then you will be able to benefit if the market rate is more beneficial. But if you want peace of mind, if you want a good night's sleep, if you want certainty in life, then in that case you will end up going for forward rates. Okay, you will end up going for forward rates. Over here, if you need flexibility, then you go for options. If you don't need flexibility, go for forwards. There are a few other considerations as well, which is if you are willing to pay premium or not willing to pay premium, if you need cash today or you don't need cash today, so on and so forth. There are a few practical scenarios which you can read. I will zoom this out. Maybe you can take a screenshot and ideally pause the screen and kindly read this. Okay. In exam, you can be given such a exhaustive example where you calculate forward contract also, money market also, you calculate the option also, and then you see what did you have to do. You have to make the payment. In which option do you have to make the least payment? If you compare the three values, 1, 2, 1, 2 and 3, if in the three values which is the cheapest, if this is the cheapest, then you go for options. If forward rate is the cheapest, you go for forwards. Okay, if you want certainty, you go for forwards. If you think euros might strengthen, then you go for the options. Okay, you can read this example as well. Finally, there is a statement of financial position hedging which addresses the translation risk by matching the foreign assets with the foreign liabilities, which is you take the loan in the same currency as your subsidiaries net assets. You can read the example. They have $15 million of Australian dollars of asset. They will take a loan of $15 million so that their asset loss, if the Australian dollar depreciates, then your assets value will go down, but then your liabilities value will also go down. So you will set to gain, and hence there is a net zero impact. It eliminates the translation risk. Okay. Finally, all the summary and exam tips. Please read these exam tips. These are the common mistakes that people make. Please pause. I'm again and again saying, please pause the screen. Please read these exam tips. Absolutely, tips important. And also see the exam approach as well. Okay. You should pause the screen. You should take a screenshot. Please read the key formulas. Please see the key steps. Eventually, this chapter is all about logics. It is super simple. Just try to understand the logic. Just try to revise over and above, and just try to keep practicing the questions. I would say that's it for today. Let us come back tomorrow. We will resume tomorrow at 7 p.m. India time, 7 p.m. IST on 2nd March. Tomorrow we will continue with the concept of interest rate risk management. Thanks to all of you, and please if this video has been useful to you, do not forget to share it with your friends. Make sure that this is helpful to everyone who watches this video. To all those ACCA aspirants who are giving the examination, try to make this video reach to everyone if this video you think is helpful. Of course, needless to say, do like this video and comment on this video that this was helpful, if it was indeed helpful. If there are any suggestions, any feedback or any queries as well, please do put it in the comment box. And lastly, do not forget to subscribe the channel for more such videos and more such exam tips. All the very best. See you tomorrow at 7 p.m. 2nd March India time. See you. Bye bye. All the very best.